Namaste, investors. It is with great pleasure I share with you that we have completed 1 year of operating our small cap and micro cap advisory services. And although the market has been really good in the past 1 year, henceforth, results have been pretty decent. But when we launched this particular service, there were several apprehension कि market तो already top हो चुका है and कैसे आपको इतनी comfortable valuation मिलेगी in current scenario because during that particular time भी same question सब पूछ रहे थे कि कब गिरने वाला है market and एक साल बाद भी अभी सेम क्वेश्चन ही चल रहा है and no one predicted कि market last 1 year में इतना अच्छा करेगा. But when we did an exclusive webinar with our Mission Smile customers where we explained our philosophy, हमारा आइडिया हमेशा यही था कि मार्केट अप हो या डाउन हो देयर विल ऑलवेज बी सम एरियाज जहाँ पे आपको अपॉर्चुनिटी मिल सकती है. एंड इन दिस पर्टिकुलर क्लिप दैट वी आर शेयरिंग फ्रॉम दैट पर्टिकुलर एक्सक्लूसिव वेबिनार we will discuss our small cap and micro cap investing strategy. So I hope you will like this session. Thank you.
So if you can see my slide, this is a chart wherein we have showed the valuation metrics that market use to value the business currently. So as you can see, the market often discounts the future estimated cash flows that the company is expected to make. So during this period, market assumes that the business, based on its own competency, will be able to grow at a reasonably high pace. So this can be anything between 15 to 20% also. But after a certain period, let's say market estimates that the business can continue to grow on for next 5 or maybe even 10 years. After that, the business still exists. However, the growth tapers down. And the market generally assumes that the growth in this phase, that is the slow state period, or which is often referred to as terminal period. In that period, the growth rate will be very low. Like it will be closer to the GDP growth rate. So from this chart, we can understand 2 to 3 things. Firstly, the valuation of a company is dependent on the cash flows that it is expected to generate in future. So these are the cash flows that the market is estimating that the company will generate in future. And the cash flows can also be broken down into 2 parts. Firstly, that these cash flows won't stay at the same rate. They will grow at a particular rate. So market is projecting that the cash flows will grow at a certain rate. That is the growth rate of the company. And secondly, the market also makes certain estimation. Like I've already talked that in this period, the growth rate is very high. But after a certain point, the market believes that the growth rate of the particular company will also taper down to the GDP growth rate. That is a lower growth rate. So the market also makes estimation about the tenure of the growth rate. So for example, in this case, the market is assuming that the company will be able to grow at a fast rate for 5 years, after which it will grow at a slower pace. So this is a fast growth valuation, and this is a steady state growth valuation. And lastly, as you have seen, all these cash flows needs to be brought back to current earnings or current valuations. So that is done by discounting the cash flows. So what do I mean by discount? So in a layman's language, discount is the risk adjusted return that the market participants expect from the particular security. So for example, if market is assuming a certain set of cash flows, which if discounted by 12% gives the current valuation, then I can assume that if all the parameters check out, then I can make a 12% return out of this investment. So my idea, or the SmartSync's idea about businesses being, or the market being efficient, is that all these parameters that the market is estimating is more or less correct on a longer period. But then, how do we aim to generate alpha, even though we believe that market is efficient most of the times? So see, market is efficient most of the times, but there are still some pockets where market is a bit inefficient. So what do I mean by that? So there is empirical evidence that market fails to estimate properly the tenure of the growth period. So in our previous case, you saw that the market is assuming that the cash flows will grow at a faster rate for 5 years, after which it will grow at a very slow rate. So here the market is assuming the fast growth rate period for being 5 years. But what if there are certain companies that are growing at a much faster pace for a very long period of time. Like there is evidence in that we have seen in companies like Asian Paints or Bajaj Finance that always look very expensive optically, but because they have been able to grow at a high rate for a very long period, so market, despite giving them high valuation multiples, is unable to discount them properly, because of which their shareholders are making good returns. So we believe that if there is a business that is able to grow at a reasonable rate for a longer period of time, then market fails to value them properly. So there emerges one pocket. Then, as I've talked about, that all the cash flows need to grow at a certain rate. But how is the growth rate derived? So for example, the formula of the growth rate is how much I reinvest in the business and the return that I make on the additional reinvestment. So for example, if market is assuming that the business can grow its cash flows at a particular rate, let's say 10%. But what if this expectations changes? Now, how can this expectation change? If the business starts to reinvest more in its core business, or the return that it generates from its reinvestment starts to increase, that is the ROC that we often talk about. So ultimately, its growth rate will increase. So what do we look in this pocket? We look for companies that are either reinvesting in their business very fast, let's say through capex or even acquisitions, or because of the improvement in the existing business profile, or the tailwinds that the company is seeing in their industry. The return on the incremental capital that they are deploying improves. So ultimately, either of these two variables either change or both the variables change in the positive side, then ultimately the growth expectations will increase. And market will be quick to address that mistake that it made in the previous times. So I won't call it as a mistake, because based on the estimates, like based on what company was projecting to grow, the market would have estimated that the cash flows will grow at a certain rate. But what if the business starts to expand rapidly or the return profile improves? So ultimately the growth rate will increase and market will reflect that, which will also lead to higher valuations. Then thirdly, as I've talked about it, these cash flows needs to be discounted back to the current valuation. And the discount rate is nothing but the expected value or expected rate of return that the market participants expect from the investment based on the risks. So any discount rate has two parameters. First is the cost of equity. So this is the cost that the equity shareholders borne. Because equity is risky, so generally it is assumed that a business, if it is highly risky, then the return expectations of the investor will be higher. So ultimately, the cost of capital will be higher for a riskier investment. And similarly, the second key parameter is cost of debt. So all else things being equal, if a business is highly levered, has a lot of debt, doesn't have very good balance sheet, then ultimately the cost of debt will be very high. So because the balance sheet is not good or the risk of the business is very high, the cost of debt will be very high, which will lead to higher discount rate. So you would have seen that the risk profile of the business determines the discount rate at which the future cash flows are discounted by. But what if the business profile improves steadily in the coming years? Then ultimately the expectations of the return from the security will reduce for the market participants, which will lead to higher valuation multiples. So that is another pocket that we focus on, that businesses that are able to delever their balance sheets or are able to improve their business risk profile. So the businesses that are less risky will ideally command higher valuations. And we tend to focus on those companies which are improving their risk profile, which will ultimately lead to an opportunity for an alpha. And lastly, there are still certain pockets where market either doesn't discount the valuation properly, or there are chances that because of those particular events or that particular caveats, the valuation multiple that the company deserves now will increase. So there are several cases, like for example, demerger. So this is a very common phenomenon and I will not substantiate on that, but basically the key ideology behind this is that valuation of two companies separately must be higher than the combined entity. And secondly, if the two entities are listed separately, then there might be an opportunity or a forced selling in that particular listed entity, which will create an opportunity for investors like us to create an alpha. So this is one market nuance because of which there is an opportunity for alpha. And then again, if suppose a listed entity sees that its rival is being listed in the exchanges, but because the valuation of that other listed entity or the newly listed entity is very high, so ultimately market will realize its mistake or will, based on the market's perception, increase the valuation of the existing listed entity. So to summarize, the tenure of the cash flow projections are not estimated properly by the market. So in this pocket, we will focus on companies that can grow its cash flows at a reasonable rate of return for a very long period. Secondly, the projected growth rate. So any business that is able to either reinvest highly in its core business or is able to generate very high return on capital in its reinvestment. So we tend to focus on that businesses. Then thirdly, discount rate. So any business which is able to improve its business risk profile. So how can a business improve its business risk profile? So this can be done by several ways. Some being either because of a reduction in debt, the business becomes less risky, either because there are certain external tailwinds because of which there is higher chance that the company will be able to grow its earning rapidly in the coming period, which will lead to higher internal accruals, because of which it will be able to service its debt properly. Or either there is a change in the management because of which the market perceives that the valuation multiple for this business should be higher because the business is now less risky. Because sheerly because of the new management, which has either higher operational efficiency or experience in the market, or they basically have higher funds, which can ensure that the business will survive through thick and thin times. And lastly, there are some market nuances like demergers, listing of a new entity, because of which the valuation of the existing entity can improve. And there are several other caveats as well. So these are basically some ways from which we can generate alpha despite market not being, or despite market being efficient. So to summarize our ideology, we plan on taking advantages of either the inefficiencies or the self-correction mechanism that the market reflects in discounting certain companies. So now, what are the companies that we want to focus on? Firstly, high quality small cap companies that have high and longer tenure of growth rate or growth period. So these small cap companies can range from anything between 500 crores to 3,000 crores. So this is one pocket that we want to focus more on. So as you would have seen, that the idea behind launching this advisory is not to basically cash on some fad. As all would have seen that recently the small cap stocks are doing very well. So our idea is not to invest in these stocks because these are doing very well, but because we believe that there is certain inefficiency in the market wherein it is unable to discount certain companies that can grow its earnings for a very long period. And we believe that the odds are very high that the companies that have a lower scale but good market size to grow will ultimately be able to grow its earnings at a high rate for a very long period. So that is why we are focusing more on the small cap. And secondly, we want to look at companies that have catalyst. So these catalysts, as I've already discussed, these can be anything from a demerger to a change in management. So there are several caveats which we tend to focus on, or which we want to focus on while investing or giving you some recommendation. So I think Ankit ji can take over from here.
Thanks. Thanks, Dhruv. So I'll just add on to what Dhruv has already said is one, Dhruv, if you can just go back to the previous slide once again. So we have already covered in detail about 100 companies in the small cap area. So some people or some members were asking us that whether we'll restrict to those 100 companies or not. So those 100 companies really form a very good hunting ground for us for this advisory service as well. But we will not restrict ourselves to those 100 companies. As Dhruv rightly said, that we'll keep on looking for companies where we see that there is some inefficiency in the market, and we'll keep on looking at the catalyst. Now, this 500 to 3,000 crore again is a level, or is something which we have kept in mind. But say, for example, if we find something very, very, very attractive and has a market cap of 3,050, it's not that we'll reject it. Okay, this is just a framework or a level which we are looking at. But something exciting at 3,100 crore market cap, or even if at 3,500 crore market cap, we will not exclude that. It's not a hard stop like at 3,000 we'll stop, right? So that is something which I thought I should share with you. But more or less, we'll concentrate on the 500 to 3,000 crore market cap, this thing. So now we come to the framework which we use. So the framework which we are using is something, because we'll be covering small cap. And if you look at the micro cap in US and other Western market, it is far more bigger in terms of the market cap compared to the small cap we are covering in Indian market, 500 crore to 3,000 crore, right? So we thought to use a framework which is already there out in the open. You can search for it, which Ian Castle has been sharing in his interviews. So if you come to the next slide, you will see how we use the top-down filters. So, and it's not just जिसको बोलते हैं ना कि हम लोग खाली नाम बोलने के लिए नहीं कर रहे. We rank the companies based on these filters. These are the 4 top-down filters: tailwind, scarcity, story. See, story is also very important. People think that okay, ये तो इसकी story चल रही है, but आप just look at a few EV related companies. Even though today market is not sure how these companies will pan out, right? There are so many other issues with them. But if you would have bought them in 2016, 17, 18 and just held on to them, you would have made really good amount of wealth. A new story which right now is working currently is the wind sector, right? So story does have value. Of course, how much weightage you will give to story, you cannot just bank on story, right? So don't ignore the story stocks. It's just that you can't just invest based on one story. Yeah, based on only story, right? So story is also important. So that is how we rank all our stocks on top-down filters. ये 4 ये रहता है. Undiscovered is also a very good thing. So there are many companies which, because remain undiscovered, we find it much more. The alpha generation could be higher if your analysis is right. ठीक है, अनडिस्कवर्ड मतलब ये नहीं है कि आप हमेशा ही राइट हो जाओगे, बट अगर आपकी एनालिसिस राइट रहेगी, द अल्फा कुड बी जनरेटेड हायर. Yeah, and in the next slide we'll look at the bottom of filters. So top down filters में it was more of a macro thing, and bottom up filters में more of a micro thing, which is company related thing or business related, whether the valuation is attractive, whether the business is recession proof, how strong is the balance sheet, and intelligent fanatic is the like in case of small caps and micro caps, generally on the intelligent fanatic metric, we will find it difficult to give them a higher ranking, because intelligent fanatic immediately discover करना बहुत difficult है, right? So it will need for us also to see a sustained level of consistent performance by the promoter. Then only we will be able to call him a really good intelligent fanatic, right? It is easier to rate companies or promoters on intelligent fanatic metric when they are, say, about 5,000 crore, 10,000 crore, or more than that, right? Because then you have a track record of the promoter. But in case of micro caps and small caps, it is difficult to get that kind of this thing. But we try our best to go back to the history and see. And ऐसे ही नहीं है कि कोई कंपनी के 4 साल से रिजल्ट अच्छे आ रहे तो हम लोग उसके प्रमोटर को इंटेलिजेंट फैनेटिक बोल देंगे. We'll be very, very, very strict with these kind of things. And in subsequent, maybe Dhruv, if you can just share the this thing, that Excel sheet where we have ranked the 100 companies. Not now, but during the Q&A session, we can probably share that sheet as well, which will give them an idea how we rank different companies on these these metrics, right?
Sure.
Yeah. So next slide will cover. So I think next, Dhruv, you will be taking care of, or shall I take this? What do you say? Dhruv, are you there? Okay, then I'll take this one. So whatever we have said till now, it is on the micro cap, this thing. Dhruv,
Yeah, Ankit. Should I continue sharing or you are
yeah.
sharing? I have a short share. Okay. No issue.
Share the slide, and you want to take the micro cap, or shall I take it?
You can take it. No issue. I have
Sure.
already just a second.
Sure. So till now, whatever we have said, it is about the small cap space. In the micro cap space, we have tied up with Atulji, who has already been with us and guiding us in our Mission Smile endeavor as well. So in case of small cap, what we have covered till now, right from idea generation till the report generation, everything is done by our team. But in case of micro cap, the idea generation is been done by Atulji, right? From that stage, our team takes care of the research and making up the report, right? So we all know about Atulji. If any one of us who has not known Atulji or his framework, I would highly request you to just type in magic and misery of microcap space SmartSync on YouTube. You will get a 4-hour video where Atulji has explained his framework of investing. This is the ABCD framework, where he says that the A category and B category of business, which are very well known to the market, he generally stays away from them. His investing basket is mostly C and D. And roughly about 80% of his portfolio is into C category of stock, where whether there is a fresh approach by the management or there is a new generation joining the company, and the balance sheet and the business strength is really good, but the market is unaware of them because the company size is very small and because of the past overhang of bad management or bad business practices, right? And the D category are the most riskiest bet, wherein either the companies are in the bankruptcy, they have failed miserably because of some high debt or some bad capital allocation, or maybe because of some business related issues, and there is a possibility of turnaround in those companies, or a different kind of companies where the companies are too ahead of their time. Right now the market doesn't see any value or cannot envisage what kind of growth that kind of business can be. So these are the most riskiest bet, but also because they are the most riskiest bet, if it works, it can give you multi-bagger returns as well, right? So Atulji right now proposes to invest about 80% of, as in he does it in this way, 80% of his investment is in C category stock and 20% is in D category stock, right? So this is the selection criteria we'll be following. Dhruv, you want to take this up?
Yeah, sure, Ankit. So again, in micro caps as well, there are certain pockets wherein Atulji particularly believes that there is chance for alpha generation. So these are, as I've talked about, change in management, which is also visible in micro caps as well as in a small cap space. Similarly, opportunities across the sectors. So if the whole sector is doing really well, then ultimately we will be able to identify new companies in the particular sector really well. And that is what we believe that Atulji's mastery is, because he's able to connect the entire value chain in a very simple manner through which he can identify several companies. Then thirdly is change in products. So if some company is introducing any new product which it was not available and the market opportunity for that particular product is very high, so Atulji also tends to focus on those companies. Then simple observations. If anyone would have seen Atulji's presentation on magic and miseries, one will understand how he literally connects every small dot, like anything that he have read either on paper or any advertisement that he has seen, through which he can find new ideas. So that is another way which he used to generate his ideas. Then compensating business and hidden assets. So there are cases wherein the market is valuing very poorly the current business. However, there are certain assets hidden in the business because of which the company might deserve higher valuation once the markets identify those assets. So
So
these type
Dhruv,
of sorry.
I'll just give one. Sorry, I'm interrupting. I'll just give one example of simple observation which Atulji does. So in one of the micro, I'm not going to name it. Atulji mentioned that he could that kind of a business just by looking at an advertisement where the company mentioned in the advertisement that this is a 150 crore company, revenue company, going to do 400 crore of turnover in the next 2 years, and as in reaching the 400 crore annual turnover mark in the next 2 years, and we are expanding our team, so please apply. Just by looking at that advertisement, there was no mention in any annual reports, there was no con call of this small company, but just by looking at this advertisement, he could see that there must be some potential, and then he started his cuttlebutt process. So it's not like just by looking at that ad you will go and invest, but that can be a trigger point where you will start analyzing this business in a different way, right? Yeah, Dhruv, please go ahead.
Yeah, absolutely. And then again, as I've talked about, the huge addressable market that is being created recently, which was not present in the past. Like EV is the best case, which was not present before 2017 or 16 times. So after which its arrival, the initial players have made tremendous wealth for the shareholders. So any new addressable market that is being created, or even in the laggards in a sector which is experiencing strong tailwinds. So there will be cases where the stocks that are getting heat from everyone will be very highly valued, while the companies which are either not as good as them will command very low multiples compared to the higher efficient player. So because of this valuation mismatch, there is chances that value can be created from investing in the laggard or the second player in the industry. And lastly, huge fall and likely reversal. So this is again the turnaround strategy that is follows. That if there is a company that was doing well, but because of certain instances, the market has severely depressed its current valuations, and there is chance that the business is experiencing temporary tailwinds, or there is chances that the business has changed drastically, and there is chances that in future the cash flows will be very much improved than its previous track record. Then ultimately there can also be pocket where value can emerge. And again, this is not an exhaustive list. Atulji in fact sent us close to 18 parameters that he checks out before selecting an idea, but we kept it to only 8 in the interest of time. Ankit, should I continue or?
Yes, go on, Dhruv.
Yeah. So again, the exit strategy. So if you will see our reports or even our sample report, you will observe that we are not giving any particular target price as to that you can exit if the particular target price is achieved. So what is the reason behind that? Basically, these are microcaps company, and there are several new announcements or several key changes that can arrive in a business at any moment, which can either increase its target valuation or can decrease its current valuation. So because of this uncertainty, it is better to inform you when we believe that there is a better chance elsewhere, or one should exit the current opportunity, or either continue holding this opportunity because the story is playing out better than even we expected. So yeah, the exit strategy will be stick to the thesis. So forever, for example, if we are believing that the company will turn around its operation in let's say 1 or 2 years, and if the company is unable to do so, then we will stick to our thesis of this turnaround and give an exit. Similarly, exit price has nothing to do with the purchase price. So if we believe that the there is certain events or certain headwinds that the company is facing, because of which it will have depressed growth for next 1 or 2 years. So we will not shy away from giving you an exit despite losses. So losses are part and parcel of game. So if we will believe, we will just focus on maximizing our investors' wealth rather than thinking ki how is our win success rate. So that is the whole idea behind this. And lastly, if we feel that the opportunity is for a short period and not a long period, then we will definitely communicate that. So for example, if the stock has run up very fast in a short span of time, and we believe that the incremental return that one will get from holding this investment might not be that high, so we will not shy away from giving you an exit call. So that is the whole idea. So while researching what we will monitor, in this micro cap space, there are high chances that there will be several cases where the management is not up to the mark. So our key focus will be in checking the promoter's activity, their past track record. If we are focusing specifically on a turnaround situation, then what instances can we see because of which we have that confidence that the business can turn around and the management will be able to handle this business better in future. And then related party transaction is another pocket that we look for, because in this micro cap and small cap space, there are high chances that the promoter will siphon off money through its related party or will engage in certain transactions which will benefit the promoter entity at the cost of its existing shareholders. So we are mindful of investing in this micro cap company which have stable balance sheets and good management team, rather than focusing on facts that even though we believe that the management is not good, then if there is chance of generating an alpha, we will still not give that call. Because to us, preservation of capital is of the utmost importance, even in the microcap space. And yeah, failures are inevitable. In the microcap space, because of the sheer opportunity of making return in a particular stock, there will be high chances that suppose even if we recommend 4 stocks and only 1 out of them do well, but even then there is high chance that we can still outperform the market just from one single idea. So that is the whole idea, that in this microcap space, the chances of making alpha is very high, but at the same time, due to several other issues, there can be chances of capital destruction. So one needs to be careful before investing, but at the same time, understand the whole ideology and framework, that if one is able to create a diversified portfolio wherein only if 2 stocks work well out of 5 stocks, then even then one can generate alpha. So rather than focusing on the picks, like what is the success rate, we will ask you to focus more on the return aspect. Like how are you able to generate return from the entire portfolio? So we will follow more of a portfolio approach rather than a single stock specific approach. And lastly, in case we have made any mistake in recommending some other stock, like mistake as in mistake in either analyzing the stock or mistake in assessing its future estimates. So we will not shy away from accepting our mistakes, and at the same time, we will learn from them. So what is our differentiation? I think Ankit will take this, so it will be better.
Sure, Dhruv. So in case of our small cap advisory, we'll have 1 buy and 1 avoid report. So avoid report doesn't mean that we are saying completely stay away from business. That avoid report could be on multiple reasons. It could be because of really high valuation. It could be something related to industry which might affect the industry for the next 1 year or 2 years. Or it could be related to something inherently wrong with the business or with the promoter. So there could be multiple reasons for the avoid report. For small cap, we'll give 1 buy, 1 avoid report. And target price, will never, as Dhruv mentioned, we will never give a target price, but we'll keep on sharing how we look about the business and what is an expected return possible in the next 1 year or 2 years. Or we'll give a range. We'll not give an exact target price, but we'll try to give a range, and we'll keep on updating. It's not like एक बार report दिया और उसके बाद हम लोग भूल गए company को. Whenever a company comes to our coverage universe, we will keep on updating. We will keep on following up. And in case of micro cap and small cap, even though we'll be holding quarterly webinars to discuss updates on these companies, we will not wait for webinars to happen. Whenever there is an important update related to any company which we are covering, we'll immediately shoot an email and also mention on the WhatsApp group of for the members, so that immediately our members come to know that this is what an interesting or an important event has happened in the company. This is what SmartSync services is doing in their own portfolio. So that brings me to the point that we have full skin in the game. We have set aside a decent sum of amount from our SmartSync services, and we will invest in all the ideas which we'll recommend to you. It's not like that we are just recommending. And so the idea is we'll immediately send you on WhatsApp and email that this is what we are doing because of this new event. And then you are in a much better position to take a call immediately. Because small cap and micro cap mein kya hota hai ki agar main, if I wait for quarterly webinar to explain to you what has happened, by that time, probably the damage will be done in the stock price. Yes. But having said that, there still will be events where when the event comes to our notice, after that, the stock price will go down. So these are all part and parcel of the rule of investing in small cap and micro cap. So don't try to think that we have a magic wand and we'll secure you from all the losses. Those things will keep on happening. Our position is very clear that we have put in our skin in the game, and we have been in micro cap. We are taking someone who has a 30-year experience in the industry. In small cap, we have already covered 100 companies. We are already, if we take the total experience of our team, we have more than 20 years of total experience in the market. So we'll try our best to give you that, and we'll be honest, and we'll be very agile to report to you whenever there is a change in any thesis or any new important this thing happens. The biggest difference or the unique nature of our product compared to any other in the market is we being more transparent and you have been, since you are a Mission Smile member, you would be knowing over the last 2 years how we have been conducting our webinars. That webinar thing will continue in this small cap and micro cap advisory as well, where we'll keep on sharing everything in detail, honestly accepting if we do any mistake, and keep on updating on what is our current view on the company, which we have covered 3 months back, 6 months back, or even 1 year back, right? So it is never like one blanket recommendation diya aur uske close kar diya. Many companies or many players in the industry, they'll say that we recommended the stock at this price. Right now we recommend a hold. Right now we recommend a sell. Now this is out of our coverage. So in our case, out of our coverage, stocks will be very, very, very low. That is what I can guarantee. And we will always be available to, because we try, before launching this, we did a survey and we tried to ask members or investors what is the pain point they are having. So even though there are some really good players in the industry who are giving some really good calls, the main pain point for most investors is they are not approachable to discuss and give you a customized service in terms of कि कहीं पे आप stuck हो गए हो तो क्या करना है. We are always available. That is the only thing which we can share with you. And I think with this, we come to the end of the presentation.
If you like this session, then you can consider joining our stock advisory services. Link for joining is in the description box below. Thank you so much for watching this session. Goodbye.